Welcome. Happy Monday, everybody. Welcome to our Trading a Smaller Account webcast. I'm Connie Hill. Happy that you have joined me here today. Barb Armstrong is well on the road to recovery. I'm just filling in for her as she goes through her knee replacement surgery. And the reports are that she's doing pretty good. I think we'll see her back here pretty soon. In any case, lots of familiar faces. I want to welcome you here. I've got to put a shout out to Ray here. Ray is in one of my favorite cities, Barcelona. Was actually able to visit Barcelona in May and had just a blast in the country of Spain. So Ray, I'm a little bit jealous of where you are joining us from today. Now, last week we had a survey and you guys did fabulous. You gave me a lot of feedback and a lot of comments and questions that I think I can just knock off pretty quickly. So we're going to do that. The other thing is last week I showed you how to put on two different targets on a trade. So maybe a first target, then a second target. Some of you said, could we go through that again? It was good to go through it, but could we do another example of that? So we do in our new trades today, we will do one example trade where we do just that. All right, let's go. Let's go welcome Mike Fairborn. Mike Fairborn's in the chat, fellow friend and coach, great veteran of the markets. As you know, as you attend Mike's classes, and especially his Think Scripting class, I think that's a real powerful one. In any case, Mike's here to help answer questions. He'll catch anything I can't quite catch, but I will keep my eye on the chat, and as you have those questions, type them in. Those of you listening to this on the recording, when you have questions, put it in the comments section in YouTube, because I go back and look at those during the week. I get your questions answered pretty quickly as well. Okay, hope you're following us on X. I'm Connie Hill CS. Mike is Mike Fairborn CS, and we put out some little educational goodies, things we notice in the markets and charts that we think you might be interested in. So it's free, follow along. Options carry a high level of risk and are not suitable for all investors. What we talked about today is for education and informational purposes only. Don't consider it a recommendation. We will be using the Paper Money software application. That's what you download to your computer. Some of you are new to this and have asked where you can find more information on it. That's one of the questions I'm gonna hit real early here. But practice in it, okay? It's a fabulous tool to get used to the buttons and how you do this, that, and the other, okay? Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. Now, typically in this class, we're going to go take a look at the market, see what's going on. Probably not a huge change from what we were seeing on Friday. Always going to look at some example trades, follow up on some of the trades that we have in the hopper. Sometimes they move a lot. Maybe between Monday and Friday, they move more. Between Friday and Monday, they don't move quite so much, right? Because it's over the weekend. But there's a couple things we'll review here real quickly. All right. This class, we conceptualize here that we are just working with a $20,000 paper money account. Now, that could be the amount you're allocating to work with as more active trades, or it could be, you know, somebody's beginning capital and your number might be different. You might be starting with 30,000. You might be starting with 5,000. Okay, take the concepts that we're teaching and then modify them to your account size, okay, whatever that might be. We'll only put on a position on a stock we won't spend more than $5,000 on it. That's our max. We'll allow ourselves to risk on any particular trade between $400 to $500. We will not go over $500, not even $1. We won't even do 501. So that's going to allow us to focus on shorter term opportunities and intermediate opportunities. Not really doing much buy and holding, not dividends, none of that type of thing typically in this class. We're going to play both directions, both bullish and bearish here, the strategies we typically focus on. Although once in a while, we might do something a little bit different than what we have listed here as far as those strategies. When the market's a little bit more bearish, and it hasn't been a lot bearish, but when it is, we'll look at long puts, long put verticals, and short call verticals, and sometimes we'll discuss iron condors and calendars. All right, let's take a quick look at the markets here, and then we're going to answer the first question. All right, SPX, what's going on today? Well, you know, you probably know, up a little bit, down a little bit. Now the SPX is up a little bit, only what, 0.13%. Markets are relatively flat. this morning. NDX is fairly similar. It and the SPX hit a new high last week on the 31st of July. So before we turn the calendar, so that was on Thursday a couple of weeks ago. And that's exactly what that index was doing, and the NDX was just putting in higher highs, all-time new highs. Boom, today, look at that NASDAQ, another all-time high. So definitely the market keeps grinding a little bit higher. We had this little pullback both on the SPX and NDX. It came down to the 30-period moving average. That's my red line. The blue line is a 10-period moving average, which makes sense since we're focusing on shorter and intermediate type timeframes. Now, if we're seeing the SPX up, what do you think the VIX is doing? Do you have an idea in your head? Hopefully you know. Okay, we would expect the VIX to be what? We would expect it to be down maybe a little, not a ton, but at least a little bit. And it is, right? It closed here on Monday, maybe around, let's see, pretty close to its low, closed at 15.15. And today it kind of gapped up a little bit, starting to pull back, but overall it's definitely up higher than where it closed on Friday. Okay, so it's down here in a lower volatility range. And so we're probably seeing a lot more call buying than put buying, right? In that ratio, the put call ratio. So all in all, I'm going to say maybe focused a little bit towards the bullish side, but there could be some of you that are feeling more neutral, that are feeling like, hey, there's some bearish opportunities here and there. In some of our classes, we've explored doing some bearish opportunities. As the market kind of grinds a little bit higher, where the weakness, where we might see a little bit here today, looks like maybe the Dow is down a little bit, 0.17%, which isn't a ton. But you will notice the 10 moving average is headed down and it crossed down below the 30. Looks like maybe that was either on Friday or Monday. It's really super evident here today. And then the Russell 2000 that tracks the small cap stocks. We don't do a lot of small cap stock trading in this class because we're looking for liquidity in the options. And so we're going to find those typically in larger cap stocks and very large cap stocks. So it looks like maybe it's a little bit flush here, up, I guess, 0.2%. So maybe up a little bit. But you can see maybe 4 out of the 5 days here, the shadows on the candle bodies they're not huge, they're smaller. So that kind of gives us an idea that volatility around the Russell 2000 maybe isn't a lot. I mean, there was some volatility here this day where we have the big candle and it had some shadows high and low. Okay, that gives you an idea as far as, okay, what do we expect from our markets? Now, I'm going to answer a question that came in here. Question number 1 is, how much capital should be allocated in each trade in my portfolio? Okay, we're going to step back just a little bit to what we just talked about in terms of the rules. We're looking at a $20,000 account here. And so on our $20,000 account in this class, we're willing to risk $400 to $500. What does that equate to? Yeah, that's not a whole lot, right? You can see up here a 0.5% is 100. So you can know, oh, okay, then I guess maybe instead of a 0.5%, like 1% would be 200, 2% would be 200. We might have to stretch the rules, bend the rules a little bit in order to actually trade when you have a smaller account. Now, if you say, let's just say you have a $20,000 account, your number's going to be different. You might want to determine how many trades you can handle at a time. Okay, there might be some of you that say, you know, I keep really good track of 3 or 4 trades and that's about it. There may be others of you that say, I can handle 10 trades, no problem. Okay, so depending on your individual capacity, how much you want to watch the market, how much you want to follow your charts during the day and keep track of those trades for shorter term type opportunities, it gets a little time intensive. So there's not going to be one magic thing for everybody. Okay, but maybe I would say see where your comfort level is. If you're comfortable at 4, don't be putting 8 and 9 trades on. okay? Because then you're going to get burned out, you're going to get lost, you're going to lose track of things. All right, so find where that is with you as well as your allocation. If you're working with, say, $5,000, you might say, okay, I'll divide it up between 4 or 5 trades, 3 or 4, maybe even 3, okay? So, and as your account changes and morphs and grows, you'll be able to adapt those rules a little bit more. I'm going to answer one more question, then we're going to get to a trade here. The other question that came up was about, I'm a beginner with somebody out of beginning with Thinkorswim, beginning with options. So let's take a trip over to the website of Schwab. And on the Schwab website, I'm going to come to the Learn menu. We're going to come down here to Schwab Coaching. We're going to come down here to live webcasts and virtual workshops where you can see the schedule. One of the places you can see the schedule. One thing you can do on this calendar is you can filter it. You can say, I am a skill level beginner, and just say, only show me the beginner stuff. Okay, this class is actually an intermediate level class, and so we might go a little bit fast for some of you that are newer to the strategies, but keep with it. You're going to be still picking up a lot of stuff, even if you don't capture every last thing that maybe might come out of the session. Okay. So getting started with options, that's going to be Cameron tomorrow at 12 p.m. Eastern time. So on Tuesday, he'll be teaching that class. That'll be tomorrow on the 12th. And then the next day at the same time, 2 p.m. Eastern time, he'll do Getting Started with Thinkorswim. And so if you just need to focus on some of those beginner elements, great. Even though you're learning option strategies, it's not a bad idea at all to hit Scott Thompson's class that was just on before our class here about stock investing for beginners to give you a good idea of what you do with stocks, because you've got to understand those stocks so that you can trade option strategies. Okay, so all right, we've knocked 2 questions off the list. Let's get to our first trade. All right, hop on over to our Thinkorswim here. Hop on back here. Let's pull this up. Let's see. I hope this is still good. IONQ. All right, this is a stock that it might have been on our early morning mover scan. I guess it was. I have a couple columns here, 1 month performance, 3 month performance to get an idea. Hey, are these stocks moving around or what? This one's up about 26% over the last 3 months, only up 5% over the last month, but it's kind of been in this consolidating triangle here. And what I noted today is it looks like it's breaking out of it, right? These lows kept getting a little bit higher, but the highs kept getting a little bit lower, forming this triangle. And so it can break out either direction. Typically, it'll break out the direction of the previous trend. And we could say, okay, even before the triangle started, we had some uptrends on the 10 and the 30. So we might be looking for a break to the upside, but it really could go either way. Well, on this particular stock, we can use that triangle to identify a target. Now, it's also at its all-time highs, okay? You can go back and check it if you want. I did at its all-time highs. It's only been around, I think, since 2024, like February or March. How might we determine a target using this triangle? Well, using this triangle, I'm going to take the second point in the triangle. Okay, point number 1 is down here on the first touch. Point number 2 is up here on the second touch. Okay, that's the other line. And I'm going to start at that line. I'm going to go straight down to where it intersects with the bullish upward trend line. And that gives us the height of the triangle. So what some technicians like to do is they'll say, okay, based on the height of the triangle, that's the kind of target that we expect. Okay, so on the target that we expect, let's come over here. Let's duplicate the drawing. Let's grab it. Let's move it to where the breakout is. And I'm just going to set it right on today's candle, right at that white line. And that gives us an idea, okay, where do we expect the candle or where do we expect the price to go? We expect it to go past its highs that are part of the triangle. And it looks like it's maybe going to go past this 48.94 that was its previous all-time high here. Looks like the target on that's pretty big. Now, it's ambitious. It may take some time to actually get up to there, so that can be a consideration. Let's see here. Deepak had a question here. I'm gonna entertain it for just a moment, then we'll hop back to our trade, which was, are we using 20,000 because we want to be shy of a disqualified as a day trader? Not necessarily. We're just using that as an account value. Like I said, your account could be 30,000, could be 25,000. Okay, we're really not focusing in day trades in here, but we are focusing on shorter term type opportunities. Some people will focus on some swing trades, and that's a class Mike Fairborn teaches. Mike, is that a Thursday class? Maybe you could put a playlist into your class when you teach that. I think it's Thursday, but I sometimes forget. Might be Wednesdays. Okay, on to our target, on to this trade. Let's go to the trade tab. What do we got going on here? We're seeing a lot of implied volatility in here, aren't we? Yeah. What does that mean? It means an expectation for a pretty big move. Now, it's not necessarily using this triangle. It's using how the price has moved over periods of time. And you can see it's got some decent sized candles in here, letting us know, yeah, it's been a pretty big mover. So we could take a couple approaches here. One, we could take an approach of maybe doing a swing trade using that target of the P on the symmetrical triangle. We could also say, maybe let's sell some premium. Okay, we're going to go with the first one. We're going to sell some premium, but you could do a number of different trades with this stock. But since it broke out in the bullish direction, that's probably what you'd focus on. We're going to use the September options. They're the most liquid ones. There's a few out here in the weeklies, but just maybe not a ton to work with. And this is something that I found interesting. We'll see if this spread is still looking good here. Stock's at 44. Initial trade that I was looking here was the 39.38 spread. I'm going to do a sell vertical here. It's just $1 wide. It's nice to have some dollar wides in a smaller account, because if you can only trade one contract, if you could only risk $50 a trade or $100 a trade, it's nice to have something in single increments that you can work with. Okay, and I love the open interest out here. Now I'm gonna freeze this. We're gonna click on the lock and lock that in place. Many times we'll look for a 30 to 40-ish delta. Look what this delta is here, 24. Whoa, it's even way lower. And we might, before we had probability of expiring out of the money or in the money on these calculations, like we have in this column here, this column saying 66%. We used a delta as a rough estimate for expiring in the money. And so if we took 100 minus 24, that would give us about what? About 76 probability of expiring out of the money if there's a 24% chance expiring in the money. Now, this calculation is a little bit more in depth, and so we're going to use it. Okay. How would you like to sell something with a 24 delta that has a 67% chance of working, of expiring worthless? Yeah, we like those odds. What's the percentage going to be on this? 0.3 divided by 0.7, our max gain divided by our max loss, 42%. Okay, that might be a little juicier than some of you would expect on a spread trade of this nature. We could spread it out by 2 if we wanted to. I'm going to leave it in the single digits because this is a smaller account. If we're risking $70 per trade, how many contracts could we do? We could do 4. Could we do more than 4? Let's divide it up here. Let's go 500 divided by our max. That's our max loss. 500 divided by 70. Oh, we can actually do 7 contracts. Let's do 7 contracts. Our max theoretical gain there would be about 210, but would be risking a lot more. Why would we do that? Because of the probability of this option expiring out of the money. Okay. Then when we see the high implied volatility, you don't have to pick this trade. It's just one that we're going to pick. Okay. We're going to do a first trigger sequential here. We're going to do a create opposite order. And if you wanted to even be less aggressive, if you were like, I would feel more comfortable selling a 21 delta or an 18 delta, run the numbers on it, see if it meets your minimum requirements for a reward. But it might, because there's a lot of volatility priced into these options. Okay. When we get a chunk of our 30 cents, we're going to get out. We're going to put an order to exit so that we can be walking the dog, we can be out golfing, we can be just ignoring the markets and let the technology, right, go ahead and execute that trade for you because you put it in advance. Okay. 30%, well, let's see, 30, if we got, say, 70% of this, 30 cents, that would leave us with 30%. And some people might be happy with that. Some people might want a different percentage. Just for this example, we're going to go 30%, which means we're going to take that value of 0.3, we're going to multiply it by 0.3 because we're going to say when we get 70%, only 30 is left. Let's see if that calculated it for us here. I think let's go 0.3 times 0.3, 9 cents. We're going to go buy it back at 9 cents. Would be happy campers if that happened and would be on our way. And let's make that keep it as a limit order. We need to make this good till canceled. Okay. Jackson's price might be jumping down to 0.2. Ooh, let's see the most recent. Well, 0.29. It might be jumping around a little bit. I'm gonna keep it at the 30 here, and we'll see if we get filled. If we don't, I'll go back and change it so we can get filled on it. All right, trade number 1, we're gonna hit confirm and send. We're gonna put it in our bucket where we track our trading a smaller account trades. All right, first one down. We'll look for it to fill. There it goes. All right. Villager says, what advantage do options have in a smaller account over stock trading? Great question. Yeah. I think the biggest thing that it helps a trader with is leverage. Okay. Let's suppose a stock goes up 5%. Great. Goes up 5%. We're happy about that. But if the stock goes up 5%, an option price is going to be going up exponentially. The option price might be moving 20%, might be moving 50%. Okay. It's a big leverage factor. And so for the same money that you can put into the trade, you get a higher percent return. We use a lot of verticals in here because spreads allow you to have a maximum fixed gain and a fixed loss. And a lot of the contract prices, if we're using some stocks that are a little bit higher priced, in order to even trade them in a $20,000 account, we need to do a vertical. Okay, for example, say on this, if we wanted to buy just say one long call here at the money on the 44, it's over $500 and we can't risk more than $500. So that would be excluded here, right? We couldn't do it. That's one of the reasons we're going for the vertical and why we are going for that one. So I appreciate that. Yeah, the volatility is high, Carol. Chris Carroll says, absolutely it is. We looked at that first thing. Okay. Does that mean it's a bad thing if volatility is high? No, it just means the market's expecting it to move and it's pricing the options like it's expecting it to move, right? Higher implied volatility priced into these options than say something that maybe isn't moving around a whole lot. Something we used in this class is also looking at the beta. If SPX stock moves a value of 1, beta of 1, then you compare your stock to it. Man, this is a 2.4. So if the SPX moves $1, we would expect this stock to move $2.49. Okay, so yeah, it moves significantly more than an average stock in the S&P. Okay, good questions you guys are bringing up here. Jackson, why don't I choose a shorter expiration to sell? Because the open interest isn't that liquid. If I come out here, say we go to a 30 delta, we've got 15 contracts, 40 contracts. There's some volume coming in today, but there's just not a lot. So we want to be a little fish in a big sea of contracts is really what it amounts to. Okay, next one up. Last week, this is going to be a little bit of a review. We're going to mix it in here. Last Friday, we did a trade on FCX, and this is where we got into our 2 target orders. Ooh, I wonder if one of ours hit its target. I think it was FCX. Let me look at my notes here real quick. We did. Let's come up here to our filled orders. This could have filled here this morning. Without me seeing it. No. Let's see if one of them is in the unallocated space. If it's in FCX, where did he go? We did a couple of trades on Friday. We did 2 different trades on FCX, and we put 2 targets. Well, we did 2 contracts. Actually, this is what we did. I did it right. Our 2 contracts are sitting here, but they have different targets. Okay. If we come up to the working orders, and let me show you this, point this out in our working orders. We have 2 different targets. First, if the price of the stock gets to X value, and then if it gets to higher X value. Okay, so here they are right here. If we look at here's our FCX order. We did a first triggers 2 OCO. And what you're going to notice here is that a couple of these, well, this is the current price. A couple of these say a market order and a market order. And that's where it was based on the price of the stock. We'd have to go to the gear to see what that was. And then our stop order was, actually, I'm going to erase this. I'm going to erase this and start my comment over. Okay. The one that's showing as the price column is a market order. If I go and tap on that gear, we'll see what price the stock needs to be. In this case, the stock is 40.47. Is that higher or lower where the stock is? It's higher. Okay. On this market order, this market order here, we're 40.47. Let me look at the chart here real quick. Yeah, because that was going to be just kind of down below. Oh, I'm on the wrong stock. No wonder. Okay, there we go. This will make more sense. Okay, here's our orders, and we're seeing them out here. So the first target's up here. And if I put my mouse on it, it balloons out, and it's looking for, let me move my mouse a little bit over here. 381 is our target number 1. 445 is our target number 2. So we said if it gets to this price, sell 1 contract. If it gets to the higher price, sell our second contract. Okay, that's what we're looking for here. Again, we did this Friday, so it hasn't had really a chance to move too much, but the stop loss has to be the same in both those orders if you want your stock to get stopped out or your options to get stopped out at a certain price. So I'm going to show you that again. That's what some of you requested in the survey last week. You said, "Could we do another trade like that?" So yes, we're going to do a trade like that. Shashi is giving us some details. Yeah, our target was 381 and reversed at 350. All right, let's go to the trade tab here. Oh, actually, our chart we're going to look at. Well, let me show you what we're going to do it on first, okay? This is a stock that's moving around a lot. It's very volatile. It's been has a lot of premium associated with it because these moves have just been so big. Okay, you can see this is the 3-month chart we have on here. A low price was $6.42 and it ran up to $20.95. And that's less in 3 months. Okay, so and it's back down here. So maybe it's going to start moving in a horizontal range here. We don't really know, but the 1624 area looks like a decent level of support. And today it looks like, at least at this point, it's bouncing off of it. Okay, so we're going to use it as a bullish bounce entry. Now we're going to go over to the trade tab. We're going to be a little intense on the tools as we go through this trade. Okay. Because we're going to use both our technical analysis and we're going to use the Theo Price calculator. How many of you are comfortable with using the Theo Price calculator? If so, chat in, let me know. If you are, tell the dog I am, yes, or I'm not, no, using the Theo Price calculator. One of our columns that we can choose here is this one here that's called Theo Price. Okay. And so I'll have it on the screen quite a bit of times when we're doing option trades. And what it allows us to do is to play what if. What if the stock does this? What happens to the option price? Now I had some numbers in there, so I just hit reset so it would put everything back to 0. Okay. Ooh, there's a few yeses in here, but also a few no's. Okay. Yeah, let's show you how this is going to work in conjunction with a 2OCO order. Okay, so I said we're getting a little bit deep into the tools here today. That's okay. It's an intermediate level class. You guys want to know stuff. You want to know this kind of stuff. All right. So on this, our first target, we're going to have it be $1.50 higher than where the stock is right now. Okay. This range here, and let me just drag this line here. Let's go maybe from the peak of that 2095 down to here, and we're going to have to scrunch that so we can see down. So the height of that area is in the neighbor of $4.63, and that's at the all-time high. We're not going to reach for the all-time high there, okay? And it's 22%. I mean, that is a huge percent. Okay, so number one, this trade that we're going to put on is aggressive. Okay, this is not for everybody because of the volatile nature of this stock. Okay, so we're going to come back here to our trade tab, and we're going to use our September options because we think it could move pretty quick because it's a volatile stock. We want, maybe give it a week to make the full target, and a few extra days is why we're going to go with these options, plus the fact that the weeklies weren't quite as liquid, although if you're just trading one contract, you might find something there. Okay, so this is what we're going to do. We're going to buy, make sure this is the same strike price that I wanted here. We're going to just do the at the money. Which one's at the money? 17, right? Stock's at $17.18. This is our at the money option. If you want to be a little bit more conservative, you could go to the 66 delta. Okay. We're going to do the 58 delta. So we want a little bit of intrinsic value, and we want to buy this call option. Now, the question is, well, what is going to be our first target using the theoretical calculator? Okay. Notice how tight this spread is. It's been vacillating between a nickel and 10 cents. Oh, we love that. We like it to be really narrow. And let's pull up the calculator, and what we're going to do here, this area that I'm moving my mouse around in, if you have the Theo column selected, this is where the calculator sits. So we're going to say for our first target, we want it to be based on the price of the option going up to $1.50 on the price of the stock. Not the option, this is the stock. You can see that word there, stock price adjustment. And we're going to give it a little bit of time. Today's Monday. Let's go out to the 14th. Okay? Go out to the 14th, Thursday. We're going to say if the price of the stock moves $1.50 up, what will be the value of our option? The value of our option at that time is going to be in the ballpark of $2.83. Okay, so we'd pay $2 for it. Maybe we can get it for $1.95 and have it go up to $2.83. That would be the value of the option. So we're going to write that number down. And then for a stop, we're going to put it at 50% of the price of the option. Sometimes that's where traders draw the line. They're like, man, if I'm down 50% on it, it's not working out for me. Okay. And so in this case, it's going to be in the neighborhood of a buck. right? Now it's right now at 195. So let's go put in that first order. So that first order, we're going to have a stop at the option price of probably $1, might be a 99 and 95 here. And then our target one is going to be, now it's moving around, we're going to put our target at 280. Okay, so this is first trade. Going to click on this. We're actually going to do 2 contracts here. We're going to do a first triggers to OCO. So our first order going in is going to trigger another order. So we're going to do right here 2 opposite orders. So to create opposite orders here. And then we're going to put the conditions on it. So this first one, let's make that our target. Our target right now is, we're using the Theo price. Let's just go with 280, okay? 2.80. And 50% of the price of this option is going to be in the neighborhood of what? About 98 cents. Okay, so we're going to put this at 98 cents for our what? Our stop. Now, the trade we did on Friday, we based only on the price of the stock movement. This one, we put the stock movement into the Theo price calculator. We're doing it based on the price of the option. Now, both of these we want good till canceled, okay? So our first order is set up with the exception that I got to change the contracts here. We only want to do 1. Oops, come on, little guy, get on the right thing. There we go, one contract. One contract. Okay, because that's our first target, our first stop. Okay, let's go up to the Theo price calculator again. And let's bring it up. And the next target is going to be if the price of the stock goes further. What if it goes $3 higher? Up to that peak was a $4.30 something cent move, right? And so we're aiming well below that peak. Let's put this target in for $3, but we're going to need to give it a little bit more time. Okay. So this one, instead of giving it till Thursday, we're going to go to next Monday, the 18th. Okay. That's what we're hoping that it moves quickly, right? We do it a long call. We want it to move quickly. What would the price of the option be if the price of the stock went up $3? Well, this is saying the option price would be in the neighborhood of about 383. So that's going to be our second target. Okay, so let's go into our order. Let's fill that out. We had said 2 OCO, and this is just the first OCO. Hits 280 in price or hits stop price. Now I'm going to make a duplicate order right here on the first one. So I'm going to say create duplicate order. And then I'm going to create a duplicate order of our stop loss. And so we're going to say create duplicate order here. So our stop loss is going to be identical. Okay, it's going to be the same thing it is there. But this one, we're going to change the price on that second contract. And we're going to put it at $3.83. Now, we're just putting in assumptions. We don't know if the stock's really going to do that. We're wanting the stock to do that, but we don't really know, right? And if it does it more quickly than we expect, awesome. We'll take it. We'll love it, won't we? Yeah, we totally will. All right. So 280 is the first target. 98 cents is the stop loss. 383 is the second target. So we're splitting the contracts up, 2 different targets. Stop loss is the same. Okay, are you guys tracking with this? Any questions before I hit the send button? Any questions before I hit that send? No, it's your time. Okay, we're going to go ahead. We're going to send it in. We're going to watch this baby. We're going to see what happens. Now, our trade on Friday just hasn't moved a whole lot yet, right? That FCX order. And we did that based on the price of the stock. All right, good. We got filled on our 2 contracts. We're happy. We're going to be watching that. Okay. If this is something that interests you, I would practice it out in your paper money account. You could do this trade. You could do a different example trade, right? In your paper account, it's where you're testing the buttons. It's where you're testing theories. It's where you're finding out, do I like doing this? Do I not like doing this kind of a trade, right? That's where you really find out is when you do the paper money trade. So I'm going to encourage you to do it, okay? If this was a little bit difficult for you, Paul, yep, 98 cents on the price of the option, not the price of the stock. This one we did based on the price of the option. Okay. So yeah, you want to make sure you're knowing, and I did it the same way on both those orders. I didn't mix and match. We're just doing the price of the option using our Theo price calculator and using about a 50% loss on the price of the option, right? If it gets down to 50%, okay, we'll be out. All right. Yeah, we're splitting it up on the two targets. All right. Let me go back here. That was a little bit confusing to a couple of you. I know it's an intermediate level class. I wanted to give some of you a challenge here today. Okay, so our first order was hitting our target at our option price is what, almost $2. Okay, we put in the first target for 280, stop loss at 98 cents, second target at 383, and the stop loss again at 98 cents. Okay, so the stop is actually the same. The two targets on the high side that are different. We'll follow up on this. We'll see how things are moving around on Friday. Maybe it will have hit our first target by then. If it hit our first target, great. If it hits our second target, great. We'll be happy campers, right? We'll be happy if it does that. All right. Excellent. Well, you guys, my time, I've got to wrap up here. There was one thing I did want to show you if we were to go and collapse our working orders. And that is just to show you on this little put. We've got 5 days. We sold a put here on this stock, HASI. It's going to expire on Friday. If somebody wants to be out of the trade, you're in kind of that time frame. 4 to 10 days is when traders who want to be out, that they don't want to follow it to options expiration, many times will exit in that window. On this trade, we're up on it. We don't mind getting put the stock. I want to hold it so you can see what happens. Okay, we are intentionally going to hold it. We're not just ignoring it. Okay, so I wanted to give you that little update. We'll see what happens by Friday. All right, you guys, you've been great. Mike, thank you so much for your help in the chat. I did not see a survey today. They gave it to us Friday, so I'm guessing there's not one, but if this was useful to you today, hit the thumbs up on the way out of the class. Make sure you subscribe so you can find our content, and then make sure to follow Mike and I on X, Mike Fairborn CS, Connie Hill CS. And coming up next is going to be Trading Technical Indicators with James Boyd. That's always an exciting class. And I'll be there in the chat. Okay, then I'll be back at 4 p.m. Eastern time. We'll do our ETFs class. That's one of the classes you've got to hit live because we can't post the recording. So I'll see you guys back here at 4 p.m. Eastern time. Have a great trading day. Bye-bye.